Okay, so we'll get started today. So hi, everybody. Thank you for all joining us on today's lunch break session. So today's session is going to be 15 financial management tips to increase productivity, build wealth, and prepare your business for sale. And we're joined by Shane Kennedy. Do you want to give a little Wayne shave? And he's a financial advisor and mutual fund investment specialist with the Cooperators. We're also going to be joined by Marc Zirka, and he's the CEO of My Strategy Up. He'll be joining us around 12:30 for his part of the presentation. And so, let me get to my slides here. So I'll just give a little brief outline of the lunch break webinars. So the lunch break webinars are held at the last week of every month from 12 to 1, typically on Zoom. And we've been having these for about 2.5 years. My name is Jillian Blackburn. I'm just doing the introduction today. Jay Woodworth is also on the call today, which she normally hosts the lunch break presentation, but is traveling today. So I'm just filling in for her here. So if you want to join our lunch break presentations every month, you can contact Brittany, who's also on the call today, at outreach@ctcns.com to get the pre-registration link or to be put on a mailing list to join the lunch break webinars. And the sessions are also recorded. So if you missed the live session at any point, you can always go back and look at the lunch break sessions on the Christmas Tree Council of Nova Scotia's YouTube page or our media page, so media.ctcns.com, and you can find the lunch break sessions there in video and podcast form. So let me go back to the slide. So today we'll get started. So I'll introduce Shane. So like I said, Shane and Marc are going to bring some high impact tips and advice to better protect your business and family, make your money work better for you, and increase financial productivity and prepare your business to attract top dollar at succession. And they're going to be providing some more things beyond there, but I'll let Shane take it from here. I'm going to stop sharing my screen. And Shane, I'll give you the power now.
Okay. We'll cross our fingers for technology. Can you, are you able to see my screen?
Yep, you're good to go.
Yeah. Well, that is awesome. So a warm welcome, and I just really want to thank everybody for giving up what in today's world time is precious. So I really appreciate you spending a little bit of time over lunch with us, and you know, we've got a bit of a fancy name there, but we're really trying to give you 15 rapid fire tips that can help your business, help your wealth. And if you're at the latter stage of your career in your business, is prepare you for sale with Marc. And I have to share, you know, and I'll tell you a little bit more about myself, but we've lived away for many, many years. And we've always been a customer of Nova Scotia Christmas trees. And, you know, living in Ontario, we wanted to take our little girls to the experience of, you know, go out and, you know, bring the saw and, you know, get the horse and wagon and go find a tree where you can cut it down. And this was outside of London, Ontario. Well, we did that. And, you know, at the end of the experience, we didn't end up cutting a tree. We went back to the lot and we ended up buying a Nova Scotia grown tree. So big thanks for saving my bacon on that particular experience. So our agenda today is again, we want to give you, I'm going to kind of, you know, be the opening act, and I'll give you 9 tips around financial literacy. Really what we want to do, and much like your business, is we just want to plant a seed and hopefully help you grow financially. This is not intended. Everybody's individual circumstances are different, and you know we'll give some high level. But again, the objective is to plant a seed and hopefully keep you all awake and engaged for the next call it 45 minutes. We'll pause for a little bit of Q&A, and then Marc will join us at around 12:30 to talk a little bit about how do you prepare your business for sale. And whether you're, you know, looking to do that in the short term, medium term, or long term, it's never too early to start. So this is a slide that I like to start with, and this is a good representation of what our life has looked like for the last 20 plus years. 8 moves, 4 in the past 10 years alone. So we've been away from Nova Scotia for 10 years, and I tell people I'm not really an insurance guy. I'm actually a career banker with more than 25 years in the financial services business, working for 2 of the biggest banks. And you know, after 10-year absence, we decided it was time to move home. And this picture is a couple things. The one on the left, it wasn't lost on me that picture is Newfoundland, St. John's, Newfoundland, and it looks actually really, really warm. 1 child. If you look at the other picture, that's actually Ontario. It looks really, really cold, and 2 children. So we had to decide to move home because every time we sold a house, there was a new child built into the mix. But in all seriousness, you know, it was because of family and community that I'm speaking to you here today. And in January of 2020, I arrived back to Nova Scotia, unemployed and ready to take on the world. And you know, the one problem was, as we all know, a couple of months later, we had a global pandemic. And I would say through that experience, I'm a big believer that everything happens for a reason, is when I decided that, you know what, I don't want to work for anybody ever again. And was fortunate enough and lucky enough to have the opportunity to buy into a full service insurance and investment business aligned with a great brand under a franchise model. And I tell people, you know, obviously we sell insurance and wealth planning, but I really tell people we're in the relationship business and in the people business. And we work with professionals and business owners like yourself, and really just folks that are looking for value-added advice. And much of what I'm going to share in my 9 tips are really what I've learned over the last 12 months being in this business, and things that I wish I would have known 20 years ago. So hopefully, you know, there'll be some new learnings for you as well. Quickly, just a little bit about the Cooperators. It's you know, 75 years young, 50 billion in assets. And I would say why I joined this organization was really, it's a values-based organization that really, really believes in community and leaving the place in better shape than what we found it. You know, our product offering is broad-based. And I tell people, you know, anything investment or insurance related outside of your pets, we can insure. So as you see, we have a full line of insurance products. We offer group, but we also have a full line of investment offerings. And I would say, you know, now if there's no better time than now, with choppy markets, inflation on the rise, to be thinking about active management when it comes to your investments as well. So this is just you know, why work with a professional, and I'd say 3 things on this slide. I would say, you're going to hear me say this a lot, but a plan, having a plan is incredibly important. I would say number 2 is really, you know, you know, looking for tax efficient vehicles or strategies that can help put more money into your pocket. And I would say the third one that really that resonated with me when I looked at this slide was really take the emotion. You know, money, yeah, family is very emotional, and so working with a professional helps you kind of remove that. You know, won't bore you with this slide, but this is just some of the what we do with our clients, and it's really about getting to know you, what's important, what your goals are. And again, I you know, a great quote I like to use is, you know, a goal without a plan is just a wish. So I'll leave you with that. Two mentions of plans already. So we're going to get into the meat of the presentation, and you know, starting in this business, probably the number 1 question, friends, family, clients, is like, insurance is expensive, and how do I save money on my insurance? And I don't know if that, you know, resonates with anybody on this particular meeting, but it certainly was for me. And I'd say, you know, let me back it up. You know, why we're seeing increases in the market is really a couple of things. You know, claims are certainly a big part of that, and that would be big claims, and this is industry wide, but also small claims. And you know, what happens is that when folks put in smaller claims, it puts pressure on the industry, and that's where you may be paying for others. So claims would be number 1. Weather, by far is something that has had an impact. And oftentimes we always think it's not here, it's not in Nova Scotia, it's out in BC. But you know, and I don't know if anybody's on the line from Pictou County or Antigonish County, close to my hometown. You know, flooding is a real risk, and global warming. And the other thing I would say is we're going through what we call in the industry as a hard market. So those are kind of a little bit on the why. So thanks, Shane, for telling me that my insurance bill continues to go up and I don't feel any better. I'd say a couple of tips on how you can actually save on your insurance. And I'd say number one by far is deductibles. And I'll maybe just speak to home insurance, just make it nice and easy. A home that is $100,000 and a home that is $300,000, traditionally in the insurance industry, they would all have the same deductible. When I got into the business, I started playing around with, well, what if we increase that deductible a little bit closer to align to the appraised or the value of the property? What would that do for your premium? Well, there's an inverted relationship. You increase your deductible and you will see a decrease in your premium. It does mean that you're taking on a little bit more risk, but I will tell you, it will save you money, whether it be on your home insurance or if you own a commercial property or if you have commercial insurance. Playing around with your deductibles is a way to save money. I'd say number two is really multi-product. So if you have one product with an insurance carrier, you will pay more than somebody that has two products. If you have three products, you will pay less than somebody that has that single product. So not only does it make your life easier as business owners by having all your business, under one roof, but you will take advantage of multi-product discounts. Second thing is that, relationships and advice matter. And I tell people, cheaper is not always better when it comes to somebody that you trust and a relationship and somebody that is giving you advice. And I would say, one of my biggest surprises in coming into this business is that it's very transactional and there's a large need for advice and ways to work with clients. Last thing I would say on this slide is, last 2 points would be co-insurance. If you own a building and you have something called co-insurance, and 12 months ago, I had no clue what co-insurance was, but really what it is that it means that in the event of a partial loss, the building has to be insured up to the percentage. Sometimes it's 80%, sometimes it's 90%. And why that's important is because if there is a loss and you're not insured up to your percentage, let's say use 90% co-insurance, then you will not receive 100% of the payout. I'll provide Jillian and the team, a little bit more information on co-insurance, but it is something, if you own a commercial building, pay attention to that clause. Lastly, I would say comprehensive water, and I talked about floods and I talked about global warming. Make sure that you understand comprehensive water. And a lot of our competition, there may not be comprehensive water, or you may have, in most companies, is about $25,000. Really, all this is flooding. Any water that comes into your house, sewer backup. This would be water backup. You're lucky to live on the ocean. Part of the reason why we moved home. Salt water, ocean spray, comp water is a real risk and something that you want to pay attention to. Number two is take advantage of tax sheltering. There's a lot to unpack on this slide, so I'm going to try to make it as brief as possible, but I would say a couple headlines. January 1st, the TFSA limit just rolled over with another $6,000, so that's number one. Number two is, I would say March 1st is the deadline for 2021 RSP contributions. So meaning if you need to get an RSP into your tax return, you have until March 1st. We work with all of the large mutual fund companies, but we had an opportunity to have Fidelity, a Fidelity retirement researcher speak to us actually yesterday. And I'm like, wow, this is going to be a lot of fun. What can we learn? And maybe I'll catch up on my emails. I got to tell you, the information that she shared was phenomenal. I'll share a couple of bullets that I took away. I'd say male and female longevity or mortality is going up. Males, statistically, we're going to live to 84 now. females, of course, are going to outlive us because they're smarter, they're more talented, and I'm waiting for Chrissy to smile for me, are going to live till 87. And the average retirement is 65. So what that means is that even if you're kind of hanging up your boots and retiring, you know, generally speaking, you've got 20 years to have some fun and spend this money. I'd say there's 5 risks when it comes to retirement that they talked about. Longevity being one, inflation being number 2, and no more real than right now is we have inflation at levels that we haven't seen in decades. Asset allocation, and you know, a quote, and you know, I'm going to steal it, but it's easy to make money when everything's good and the markets are going up. We are moving into, you know, a year where markets are going to be choppy, and you know, inflation, you know, we're not sure what's going to happen there. We still have this, you know, pandemic that won't go away. The time for active management is when, and really what that is that's what you're paying your fund managers for in your mutual fund portfolios. That's what you're paying them to help you keep the boat afloat during the choppy waters. What I would say is that, you know, we have been through this before. We will go through this again. I wouldn't panic, but you know, now's the time to buy. The other thing, there was a conversation about CPP and you know, do I take it before 65? Do I take it after 65? I'll leave that as a teaser if anybody wants to know what the answer they gave us was. But generally speaking, RSPs, you know, are really just going to help you pay less income tax, either, you know, less of a tax bill or more of a tax return. And the other thing is that you enjoy tax deferred investment growth. And there's something called the rule of 72. And really, if you take the number 72 and you divide it by your anticipated rate of return, that will tell you how long it will take your money to double. So 72 divided by, so let's say you're in a, you know, a balanced portfolio and you're making 5 to 6%. 6% divided by 72. So it's a nice little kind of quick way to kind of see how long your money will double. So the rule of 72. TFSA, not to go into a whole lot about TFSAs, but really the big difference is that withdrawals from your TFSA are tax-free. And your contribution room is restored if you do take out the year after. You know, big difference is that you're tax sheltered, but there's no tax deduction with TFSAs. I wanted to just quickly RDSPs, and I honestly didn't know a lot about RDSPs until I joined the business. And this is really, you know, a tax deferred savings vehicle introduced by the government to help Canadians with dependent children who have disabilities. And really, you know, if a resident is eligible for a disability tax credit, they're also eligible for an RDSP up until the age on which they turn 59. And I would say the stat that McKinsey gave us was that 28% of those who are eligible, only 20% of Canadians have taken advantage of these who are eligible. So just to plant a seed, if you have someone in your own family or you know someone, the RDSP is a great way to get some money from the government. I'm not going to spend a lot of time on this one, but you know, a little bit of a notable mention. Another taxable tax sheltering vehicle is a permanent life insurance policy. Number 3 is our friends, the Seg Fund. And, you know, in simplified terms, a Seg Fund is your mutual funds inside a life insurance contract. And there's a couple of things they provide. A guarantee on your principal, either upon death or maturity. That's one headline. It's a way to possibly bypass probate fees for non-registered investments. And that's because you can put a beneficiary on a segregated fund. And I would say thirdly, as business owners, it does provide a level of protection when it comes to creditor protection. You know, cons, I would say you pay more, you pay for the life insurance guarantee, so that, you know, so you will pay more from a fee perspective. And I would say liquidity. These are, you know, these are to get the guarantee on maturity at the 15-year window to realize that guarantee. Number 4, I mentioned that I am in the people business. I think we're all in the people business, unless, you're a one-woman show or a one-man show and you harvest all your trees. But, it's very likely that you rely on others to help you do that. Number 4 is really retain and attract talent with group benefits. And I did a little research in preparation for today's session around what is the cost of turnover. And there was a study by the CanadianBusiness.com that the average Canadian, and they use a salary of 48,000, cut it in half if that doesn't make sense to your business, or double it if you so like. The turnover on a 48,000 is $18,000, or 37.5%. So retaining, attracting employees is key to, certainly productivity. It's certainly key to keeping more dollars in your pocket. And group benefits is a great way to do that. I would say you as an owner will receive a favorable tax incentive. Benefit premiums paid by the employer can be deducted as a business expense. And I would say a group benefit plan typically, and again, generally speaking, have lower costs than individual insurance. And I would say thirdly, and again, we have all these big brave studies, but they did a study recently, and 87% of plan members, so people who are part of a group benefit plan, believe that this is a big part of, staying with a company, accepting a job. And so it's, the benefits are certainly there when it comes to retaining and attracting. I'm going to take a little break here, have a glass of water. Not only rapid fire, it feels like speed dating here. We're going through these questions so quickly. So number 5, corporate class mutual funds. Had no idea what a corporate class mutual fund was, being a former banker. And really, this is one that you want to pay attention to if you have non-registered or corporate dollars available. And it could be either individually or in the company. And this is a strategy that uses corporate class. They're widely misunderstood, but really how it works is that they allow you to switch investments within the corporate class fund without triggering a taxable event. The corporate class funds, and we're not going to go too weedy here. I would say if you're perked up on this slide and you're like, I'd like to learn more about corporate class mutual funds and how I can save more money on my non-registered, I've got a few spots tomorrow night. I'm giving a bottle of wine away, but we have the big smart people from Fidelity coming in to talk to us exactly about why corporate class is something you should think about when, if you have non-registered dollars. But, to kind of, summarize it, it's really, they're connected or belong to the same parent company, and therefore the taxes are all managed as one single entity. And as a result, the corporate class mutual funds can share income, expenses, gains, loss, and carry forwards. What I really say is they got a lot of smart people that are managing these particular corporate class funds that allow you to keep more of your money in your pocket for non-registered. So again, if you're interested, send me a note. I've got a couple of bottles of wine left. It's an intimate group, but would love for anybody to join us if there's interest. Number 6, for anybody who reads the Herald, you might recognize this lady. She's called the Money Lady, or Ask the Money Lady, on Saturdays. And her name is Chris Ibbotson. And, I get up really early because I have a 5-year-old and a 3-year-old. So when I read the paper, and Chris always gives me some great tips and advice. And the one that I read a few weeks ago was something that she called wilt. And it's not a wilted Christmas tree. The wilt stands for will. So number 1 is having a will, and the importance of not only having it, but reviewing it and updating it. And, we recommend every 5 years. The big, and again, I used my Google friend to kind of find out, well, how many people have wills? And an Angus Reid poll before the pandemic said that 51% of people did not have a will. So and I don't even know, I think we've got, a dozen people on here. If you're one of that 6 that don't have a will, don't be scared. One, it's not that costly. And if you don't have a lawyer, I have some lawyers that will give you the family deal. I don't do wills, but my business is advice. So have a will. Income protection. So what if you get sick? What if you get a disability? Many of us do not have protection to protect our income. And I tell people, you're a money-making machine in your basement. Make sure you're protecting you. We pay a lot of money for your car insurance, house insurance. The other thing is life insurance. So the importance of having life insurance to protect assets, replace income. And the big one for me this year is to build an asset that can really build wealth. And lastly, kind of taxation. So, using insurance to reduce tax, pay for capital gains. So wilt, remember wilt. This one is just, and I won't go too deep on because I'm watching my time clock and I'm almost at my 30 minutes, but whole life as an investment account. I probably shouldn't say this because I'm in the insurance business, but I used to think, life insurance was just, you had to have it. You hope you don't die, but you throw all this money into this, into a hole and, you never get any return on it. Not true. Whole life policies are like my new best friend. If you're a business owner, you have retained earnings in your company, or if you're somebody that has some excess capital, a whole life policy can help you build wealth. So think of it as you still have the benefit of a life insurance contract, meaning when you die, there's a payment that actually happens. So it's permanent. So that's number one. And number two is that it pays dividends and cash. And that's all in a tax sheltered, let's call it umbrella. And the dividends pay cash and buy more life insurance, which pays more cash and pays more dividends. So at the end of, 35, 40, 50 years, you have a really, really big chunk of change in cash value. And then you have a really, really nice life insurance policy that your beneficiaries, your kids, your grandkids are going to get when you move on to the next chapter. So you may say, well, that's great. I'm going to be gone. What about me? The cash value, and what a lot of entrepreneurs do is they leverage that cash value in retirement and take that as tax-free income. So whole life, I would say to plant a few seeds, you can own it individually, you can own it as a corporation. We don't do anything in a vacuum, meaning we're not accountants. We pull in your accountant to find out what the best strategy for you is. But a whole life is tip number 7. Number 8 quickly is on critical illness. And I'm thinking like, my gosh, I'm talking about all these bad things today. And critical illness is, Wikipedia defines critical illness, otherwise known as critical illness cover or dread disease policy. That sounds like a really great one. Is an insurance product in which the insurer is contracted to typically make a lump sum cash payment if the policy owner is diagnosed with one of the specific illnesses. So what I like to tell people is this is the living insurance. If you get sick and you don't die of one of these covered illnesses, you get a cash payment. So that's kind of number 1. And typically people think of heart attack, stroke, the big C, kidney diseases up there. We actually have 25 life-thrithening and 4 non-life-threatening that are covered with critical illness. The big one is that you can actually put a rider on that, which says it's called a return of premium, meaning you take out a critical illness policy, you put a return of premium, and in 15 years, if you don't get sick, you can say, hey, Shane, can you return all my money to me? So it's called a return of premium rider. And if you have the cash flow, it's a no-brainer. Again, can be owned corporately or personally. And the last thing 2 last things I would say about critical illness is, and being a banker, I remember to this day, I had a 36-year-old branch manager that called me on Monday and shared with me that she had a heart attack. And I'm like, oh my gosh, get to the hospital, take care of yourself. Friday, she called me. She said, hey, I'm back at the branch. I'm like, you just had a heart attack on Monday. She goes, yeah, I know, but it wasn't a serious one. And I asked her, I said, do you have critical illness? And she goes, I have no clue. She had critical illness, paid out paid out her debts, changed her life. So I tell you that because we never think it's going to be us. Statistically, you know, and again, our good friends in the US, they did a little study, but an age 25-year-old male has a 24% chance of having a critical illness by the time they're 65. So 1 in 4, unfortunately, is the stats. Last tip for me, and then I'm going to turn it over to my good friend Marc, who I see has joined us, is intergenerational transfer of wealth. And I'm like, wow, that is a mouthful. And really all this is for grandparents or parents with children and or an only child. You want to protect your grandchild or child. And I think we all agree as a parent, we want to do that. You personally have reached a level of financial success that exceeds your lifetime needs, and you want to transfer a portion of your wealth to a loved one. RESPs are maxed out. You're being taxed on mutual funds. A whole life policy for a dependent child or child under the age of maturity is a great strategy. It can be paid off in 10 years. It can be paid off in 20 years. And when that child is 45 or 55 or 65, they will have a considerable amount of cash, and then your grandkids will have a considerable amount of a life insurance proceeds. So I'm going to leave it at that, and I know I'm going to turn it over to Marc, but I don't know if there's any questions in the chat or how we wanted to handle questions, Jillian and Brittany. But that was speed dating. I'm like, wow, that was fast.
Yeah, if there's any questions for Shane, now would be the time to pose them, or we can do questions at the very end of the presentation if you'd like.
Cool. We'll turn it over to Marc, and I know when Jillian and Brittany were saying, you know, what's Marc's credentials and background, I'm like, listen, Marc's the smart one of this team. I'm not even the pretty face. So Marc is in all seriousness, he's a great colleague in the business. He owns a business. We don't have a business together, but we certainly work with clients together, and delighted to be working with him today to give you guys some tips. So he's going to take it home with our final 6 tips.
Thank you so much. Thank you, everyone. And I am really sorry that I joined a little bit late. I just had another commitment, which I just finished. And Shane, I am not sure about being the pretty one, because my wife is just asking me to remove the beard. So I don't know how long I can keep it. I am probably having an ultimatum and a deadline for it. So, so having said this, thank you so much, Shane, for this intro. Brittany and Jillian also as well for having us here, and thank you everyone for joining this session. Very briefly, I will just explain who we are as Strategy Up. So we are actually a consulting firm. We do advisory services in business strategy, strategic planning, corporate governance, market entry strategy, and startup coaching. We do lots of training services for organizations who wants to mainly train their middle level management and executive teams. We do leadership team management and strategic and succession planning training, and this is actually the topic of today's succession planning. And we are a lot into digital solutions and technology, because we help organizations adopt technology, and this is our mission, is to help you improve your operations through technology. And the blockchain is a very technical part which we added in the past few years, which is now the biggest topic on the technology side. I am not going to bore you with it, so we can pass it for today. Can we have the next slide, please? So why we are here, why we are here, why we are a good advisor to be next to you, because usually as a boutique consulting firm, the gap which we cover as opposed to the big organizations is that, I am not saying that we are better, I am sure the big ones are great, and there is a reason why they became so big, but as opposed to them, as a small boutique consulting firm, we are much more flexible. We might have more dense or specific expertise in one field, and we are able to really give you what you want as having, you know, as being part of the family. We have a couple of clients here, and to be honest, we are blessed for having them as clients, because most of the businesses are family-owned businesses. And I always say, when you start digging into the business, you are actually digging into the family. So you need to have someone who is trustworthy, who is flexible, who is, you know, who can build this kind of relationship. And this is why boutique consulting firms, usually they tend to operate in this environment better than the big firms. So this is all what I am saying, just to give you an introduction and the flavor about who we are and what we do. So now let's dive directly into the topic. I'm trying to mind the time, and I want to keep some time for our Q&A. So I will try to go fairly quickly with some good nuggets or golden nuggets for you. And then later we can have a discussion if you want. So why succession planning is important? Actually, it comes out of necessity. It's coming mainly because people could retire, right? You want to retire, but you have a legacy. You want to keep this legacy alive, so you want to find a successor. Someone might get promoted and they might leave the organization. Even if they are at the head of the organization, they might just decide to leave. People are quitting, and of course you might have an extended leave of absence that could be related to health issues, for example. I don't want to put here we cannot avoid talking about the elephant in the room, but I don't want just to put it on the slide. You might have also sudden death, right? And then what do we do? Right? You are a business owner, something is happening, we need to have a continuity for this business. So this is why it's extremely important to have a plan, so that we start looking at who's going to be the next person in line, right? And I understand about the emotional attachment, right? I'm going to talk about a few things around that. But just when we talk about succession planning, it could be also part of two ways: either internally within the family, so we're looking at maybe kids, grandkids, cousins, and someone who is in the family, or it could be external to the family, so we're looking to sell to an external entity, and now we are looking for a buyer. And no matter which way we want to go, we believe that we need to have some strategy that is overarching the exercise of succession planning, a very solid plan for that. And now I will give you a few tips that is going to help us move forward. So when I talk about why succession planning is important, I took some screenshots from The Godfather. Right? I think it's, if you watch The Godfather, all the series or all the movies, we will understand why. Usually you have the patriarch or the matriarch that is around the business, someone who's been there for a long time. However, they want to sell or pass the business to future generations. However, this doesn't happen with the flick of a button, right? It's usually a part of a process. And who is best to help you other than having what we call a consigliere? Right? A counselor, an advisor next to you to help you go through this process, because we understand the process is emotional, but also it's highly technical. So we don't want to miss and have a misjudgment because we are highly emotional, we're not able to see things clearly anymore, or because we have some lack of expertise on the technicalities, and then we start doing things wrong, or we take the wrong option or the least optimal option for us. So this is why it's very important. So it's a journey, right? It's a journey if we're talking about succession planning within the family, it's a journey for the family. And we understand it could be lots of ups and downs. You have some families where usually you don't have problems and everybody is understanding and it's so smooth. And you have other families where you are already into legal actions and litigations and you have this kind of tension, but still the succession planning exercise has to take place, right? So we need to understand how we do it. So it's always recommended that business leaders begin earlier rather than later talking about this exercise. And tip first is start early. This is the first tip for us. Start as early as possible in the process. I know it is sometimes painful. You know, once I wrote an article in the Business Voice magazine, probably 2 or 3 years ago, of the Halifax Chamber of Commerce. I named the title of the article was "My Business, My Baby." Right? We understand it, but it's very important to be realistic about reality of life, and then we start moving forward. On the second tip is actually we need to ensure a smooth transition. Right? Yes, we can fight it, we can debate, we can argue, but the smoother the transition is, trust me, the more value you have for your business. Because sometimes I see people sometimes fighting on the value of the business, and then you put it all, the added value, you put it all in legal fees, trying to fight for the value of the business. And then your break even is not even there. Sometimes you pay more in legal fees to fight rather than to really get the value of this. So it's very important. The more you can be, how to say, friendly in the process as much as possible. I know it's like we're not living in utopia land. Sometimes it's not possible, but it is. The third tip for us is we need to involve the right people. When we talk about involving the right people, I'm not yet talking about external. I'm talking about internally. You need to involve the right family members. And if you trust some of the employees that are not family members, but they've been with you for a long time and they are like family, involve them as well in the process. Because remember, when you do transition in an organization, you are also doing a transition of skills. And we all know that the business owners, usually they have more information in their brain, in their head, than it is on paper. It's their experience, their relationships. So you need time to transfer this knowledge to other people, to other generation, or to the new purchaser, right? So this is why involve these people as early as possible, the ones whom you trust, because you need to have a very good balance between transparency and confidentiality, right? And then the business process is very important. This is our fourth tip. You know, in order to increase value of the organization, you need to be transparent. And transparency is built on processes. The more you can explain how you do business, the more you can explain an origin of a problem or an origin of a project or the origin of the source of the income of this project, the more you give confidence. And the higher the confidence level is, the higher value you get for your business, right? Because you have a good basis of your business. The fifth tip here is actually you need to put the best team around you. So when we talk about that, and you remember I said start as early as possible, this means that sometimes the succession planning process is going to take you a couple of years, 2, 3, 4 years. So meanwhile, for example, let's say that you are working, the business is okay, but the team is not very strong. It's better to start recruiting good people so that when you sell the team, you sell the business, actually you're selling the team with it. You're selling a high level of confidence with it. You know, because also you have many people, especially when you're selling to investors or to external parties, they might be just investors. They don't know how to run your business, but they know that this business is just making money. They are investing money. They still want a great general manager. They still want a great production manager. They still want a great sales manager. And if you can give them this team, your value is already going up. You can value your business more. Now, reliable numbers. This is the fifth tip. Most important things, and many times we see this challenge in family-owned businesses, is that sometimes we mix our personal expenses with the business expenses. Rule number one, and I am sure you know it because CRA doesn't like it anyway, right? Is to already dissociate these two and then have clean books. Because, you know, I will give you an example. Once we were talking with the small family business in the Yarmouth area, and they gave me their balance sheet, their P&L, and they asked me, what do you think? What's the value of the business? And I look at their past 3 years. Every year, they had a profit of around $1,000, but their turnover was around $300,000 or $350,000. I said, how can you explain this? And then, of course, there were some mixes in expenses, or they were overspending. I said, technically, you don't have value in the business, because the purchaser is going to look at your cash flow in the past 3-4 years, and then they are going to build a valuation, and you might have a coefficient that is going to help you. But when you show me that you don't have gross profit, then the value of your business is maximum at the value of the assets. There is no added value. So we want to be careful about the books, how we do it. And then this is how we can maximize the value, show a growth. And this is why sometimes I say, you need to prepare for it. Let's say that your business now has been stagnating for the past 2 to 3 years, but you want to sell. It's not the best time for you to sell. Now you need to probably what I call double down and say, okay, I want to sell. I want to build a plan to show a growth on the next 2 to 3 years. And on year 3, this is when I will be selling, because this is where I will get the best value of my organization and for my business. Otherwise, I might be losing on the value. Sometimes you have to do it. For example, you say, let's say you are alone, you are tired, the business is stagnating, you don't have anyone who's going to help you, and that's it, you are burned out. You say, okay, you know, I am cutting my losses and I am willing to probably sell it at a lower value. But for us, we want to help you to maximize your value, to come to the optimal point, right? And this is very important to show how your cash flow and sales and your business growth is growing in the past 2 to 3 years before executing the sale or the transfer of the business for you to get the maximum value. Tip number 7 is you need to be very realistic. And here I ask you to put your emotions aside. I know it's very tough. I know how tough it is, right? But we need to be realistic, and we need to put our emotions aside, and we need to say, okay, keeping in mind people, processes, and systems. How can I maximize the value of my business, right? Don't ask for, let's say, $5 million if you know that your business actually is worth 2 million. Just say, oh my God, this is like, I cannot really let it go, right? You need to be realistic in the negotiations. You need to be realistic on the ask based on what you were able to build in the past 2 to 3 years prior to the sale date or to the exit date, right? Because I told you it's a path. Sometimes we're not ready. A couple of times we got companies talking to us and to partners of ours who are specialized in succession planning. And we tell them, you're not ready yet. We can help you build the plan. But our recommendation, don't even start putting the word in the market that you want to sell. You are already losing value. So you need to increase, improve your team, recruit, create a growth plan, show on paper realistically that you're growing. And then once you reach these thresholds and KPIs, the key performance indicators, this is when you start the exit process. Sorry, this was supposed to be tip 8. And then here you need to seek outside help. Don't think that you can do everything internally. When the right time comes, surround yourselves with the right lawyers, right accountants, financial advisors, and tax advisors, of course, because they are going to help you go through the process. You know, again, for the same client in the Yarmouth area, we're talking with the lawyer, and then at the beginning of the process, of course, the client is asking, can you give us a ballpark number how much the legal fees are going to be? Simply, the lawyer said, I cannot tell you before I hear from your tax advisor, because it depends on how the deal is taking shape. Then we need to decide what kind of legal actions we need to take to follow on the advices of the tax advisor. So going back to the same example, then the lawyer said, I cannot give you anything before I understand how the tax advisor is going to build the deal. So it's very important for you to know whom to contact first and how to build the whole deal so that you get the best out of it. Okay, so this is why, and don't be afraid, you think about the cost and all this. I think the cost that you put seeking outside help might even help you increase exponentially the value of your business, and you will recover it when you exit. But you just need to have the right plan for it, right? So just don't be afraid of this outside help. And this is all what I have to tell you in these very short 8 tips, how we can take you and take yourself as well. Not only take you, you have to take yourself, you have to embark in this journey of succession planning, but you need to do it right at the right time, and you need to know how to start. So I hope that it was beneficial, and if anyone has any questions, please, I am happy to answer.
Well, thanks, Marc. And I know this is the first time I kind of saw this presentation, and lots of learning from my perspective. Thank you so much, Shane. Thank you, everyone. And feel free to, if there's questions, I'd say for me, a couple of things when I think about, what I kind of talked about and what you talked about. I think there was 2 things that jumped out. I think the value in having a plan or the plan, and we should have kind of counted, because I'm sure between you and I, we said plan many, many times. So I think, that was a big takeaway. And I would say the other thing for me is really, and we hope we accomplish this today with all of you, is that really advice does matter. And in seeking out a partner or partners that can give you that value added advice, in my opinion, will save you and make you more money in the long run. But yeah, any questions? I'd say our contact details are up there if you want to get a hold of us. Mine is Shane_Kennedy@cooperators.ca, and we're both kind of in the big city here, but I'm a rural country boy, so I having roots in Guysborough County. Happy to have a chat with anybody if you ever want to have a one-off. I would say, both Marc and I are small business owners, and we're really, really proud to be part of the Nova Scotia story. And as you can see, we have access to the specialists that you and your business may need to help you be more productive, create more wealth, and I can't remember what the other promise was. Prepare for sale. There you go.
Yeah. Yeah, and as Shane said, I am also happy to have a one-on-one discussion, just a friendly discussion. If you need just a guidance where to go, to whom to go, we have a good network. We can guide you towards lawyers, tax advisors who are going to help you. We can help you on the business side, but definitely we keep the tax topics to tax advisors and the legal topic to the lawyers. We don't mix things. So I am more than happy to have the chat as well. Thank you so much.
Yeah, if there's any questions, thank you so much, Shane and Marc. That's a ton of knowledge that we're super happy to have on our radar here at the council. So yeah, if there's any questions for them or any comments or any inquiries about any of their material, feel free to ask now.
I just want to add on to what Julian said. My name is Lena Hoig. I'm the research technician with the Christmas Tree Council. I just want to say thank you to Shane and Marc for putting this presentation together. Often our lunch break series kind of focuses more on the management of trees, but financial management is just as important. So thanks again.
Thank you. Thank you, Liana.
Okay. Well, listen. Oh, I see something in chat. Oh, thanks, Chrissy, and thanks for the smile there too. I was calling you out. Yeah. I could see you on my screen, so I was like, I'm trying to make sure I don't put Chrissy to sleep. But yeah, honestly, I just want to thank all of you, because I know how important the industry is to Nova Scotia and how many people you all employ, and being a customer. Thank you for continuing to make those really, really awesome Christmas trees that we take home every year. So continued success for 2022, and let's hope we're almost through this craziness of the world, and we get a chance to see you all one day soon. So all the best for 2022, and thanks to the council for this opportunity. We really appreciate it. So cheers to everybody.
Thank you. Take care. Have a great day.